Hello. This balance sheet reflects the assets, liabilities, and owner's equity of a business as of a point in time, and for this particular balance sheet, that will be as of the close of business on December 31st, X1. You'll notice that this balance sheet lists first all of the assets and generates a total asset amount. In addition, there'll be liabilities and owner's equity, which the total of which should also equal the total amount of total assets. Under assets, we do categorize the assets as either current or long-term. It's important first to develop some new business terminology. I'd first like to distinguish between capitalized costs and expenses. These two terms are important in a discussion relative to long-term assets. And maybe the best way to really introduce these two terms, capitalized costs and expenses, but we're going to discuss capitalized cost and then make a comparison between those expenses. And the best way to probably do that is through an example. Let's make a simple assumption here that we're going to buy 100 pencils for our business, purchased at a total cost of $10, which is about 10 cents each. But we buy 100 pencils for $10. And the question is how would we record that in our journal and in our financial statements? It would be totally proper accounting to record this purchase of pencils as an asset, debiting pencils, or maybe call it office supplies, and crediting cash. That's totally appropriate because an asset is property or rights that have probable future benefit. Well, pencils are property. I mean, they're tangible. You can touch and feel them, and we're going to be using them in our business, and as we use them in our business in the future, that makes a contribution to our operations, although somewhat insignificant. If in fact we did account for pencils as an asset, debiting it for $10, then theoretically, as each pencil is actually used up, we probably ought to make some kind of an entry to reflect that using up of an asset. Maybe we do that through an adjusting entry or otherwise. But it would be totally appropriate upon the using up of a pencil to credit pencils for 10 cents and debit pencil expense for the related 10 cents. This kind of accounting, in this particular case for pencils, by first recording it as an asset and then reflecting it as an expense as it's used up, is referred to as capitalizing an expenditure. Now, expenditure is a term that is different than expense. Expenditure means, the payment of cash or an outflow of cash. When we make an expenditure, we're paying for something. Expenses many times do result from an expenditure, but I might make a payment of cash on, for example, accounts payable. It's an expenditure as payment of a liability. Or, I might make an expenditure in buying some land, which wouldn't necessarily be an expense. The land would actually be an asset. So expenditure does not mean the same thing as expense. Expenditure simply means an expenditure, usually in the form of a payment of cash. But the question is how do we account for that expenditure? In this case, I'm suggesting that we'll use a language that we're capitalizing an expenditure. That means that the expenditure is made in the purchase of an asset. Capitalization of an expenditure, or to capitalize an expenditure, means that we have purchased and are accounting for that expenditure as an asset, which we did in this particular case, reflecting pencils as an asset. Now, there is an alternative approach. The alternative approach would be to say, when we buy these pencils, let's just go ahead and call it a cost of doing business. Let's just expense the expenditure. We're still going to credit cash for $10, but instead of debiting an asset, we'll simply say, this is an expense. In this particular case, there may be two possible rationales for calling it an expense rather than an asset, even though from a technical standpoint, at this moment, it really is an asset because it's property that will provide future benefit to our business. Well, one of the justifications for simply calling it an expense rather than an asset might be the fact so doggone immaterial. I mean, heck, $10. Do we really want to account for pencils as an asset and have somebody account for every single pencil being used up and then reflecting it as an expense of 10 cents? The cost incurred in our accountant's time, just making the accounting entries necessary to record as asset and then to monitor as the pencils are used up and credit pencils and debit expense, just the accounting process itself probably would cost more than the pencils as a whole. So from a standpoint of materiality, this, maybe we should just go ahead and call it an expense. Hey, let's face it. Most companies, or at least larger companies, will round their balance sheet amounts to the nearest millionth. So what difference does it make on how we account for this $10 expenditure for pencils? Since they're ultimately going to be an expense anyways when we use up the pencils, let's just go ahead and call it an expense now, even though technically maybe it's not. Another justification for calling it an expense now rather than setting it up for an asset and accounting for it that way or capitalizing it as an asset really has to do with its future life. For example, I'm buying these pencils, but we're probably going to use these pencils up in the next month or so. I mean, theoretically, it is an asset now, but it's not going to be an asset for very long. So instead of just setting it up as an asset, knowing that within a month or so, all of those pencils are going to be used up and be reflected as an expense anyways, if in fact we buy an asset that really doesn't have a life expectancy in excess of 1 year, let's just go ahead and call it an expense now, rather than call it capitalizing it and calling it an asset and then accounting for the using up of that asset over the next month or so. Heck, it's going to be an expense anyways. We might also use that same justification even if it was a material amount. If in fact we're buying some equipment that theoretically is significant, maybe it costs $10,000, but this equipment deteriorates quickly and is used up, for example, within 1 month, maybe we ought to just go ahead and credit cash for $10,000 and debit some kind of an expense, the cost of machinery expense or machinery utilization expense or something, because it's going to be an expense anyways, at least within the next month or so. And as long as that doesn't extend into the next accounting period, let's just go ahead and refer to it an expense or expense the expenditure at the time that we actually make the payment of cash, rather than capitalizing it. Okay, this language of capitalization of an expenditure or accounting for an expenditure as an asset, as opposed to accounting for an expenditure as an expense, is important and useful to us as we begin our discussion of long-term assets. Long-term assets are sometimes referred to also as non-current assets. They're long-term. That means that they're not current. They're actually going to be used up in the business. They're not going to be converted to cash within 1 year. These are assets that they're going to be hanging around the business for a while. They're not current, so they're non-current assets. Sometimes they're also referred to as operating assets or even as capital assets because they're capitalized. Long-term assets basically fall into one of 3 categories. The first category is sometimes referred to as property, plant, and equipment. What we mean by property is we mean land. When we talk about plant, we mean buildings used in the business. And equipment is equipment. So property, plant, and equipment is really land, buildings, and equipment, is one category of long-term assets. This includes land, improvements to land. Improvements to land might be creating or paving a parking lot, improving the land so that it can be used in a different way. Landscaping, land would be considered an improvement. Fencing around a piece of property would be an improvement. So it includes land, improvements, buildings, machinery, equipment, anything with an expected useful life longer than 1 year, and is included in this particular definition. The second category of long-term assets is referred to usually as intangible assets. This might include patents, trademarks, copyrights, franchise rights, or even something referred to sometimes as goodwill. But again, in order for these to be referred to as long-term assets, They must be patents, trademarks, copyrights that provide certain rights and benefits for more than 1 year or in excess of 1 year. One of the things that you'll notice here relative to intangible assets is that most of these assets, well, intangible means they have no physical substance. In most cases, intangible assets actually represent rights. But that's appropriate to call them assets, even though they're not tangible, because as we've defined assets, assets are property or rights that do have future economic benefit to the business. And in this case, future benefit in excess of 1 year would be included as a long-term asset, referred to as an intangible asset. A third category of long-term assets is sometimes referred to as natural resources. There's some businesses that buy and operate oil wells or mineral deposits, timber tracts, and other kinds of natural resources, and again, as long as these natural resources are expected to generate future benefits in excess of 1 year, they would be properly included under the category of long-term assets on the balance sheet. Now, let's look at some of the issues involved in the basic accounting for operating assets. This includes issues in, first, recording the acquisition of the asset, second, allocating the cost of the asset to expense over its useful life, number 3, recording any repairs or improvements to the asset, and finally 4, recording the sale or disposal of the asset. So what we're really going to do here is kind of look at the life of a long-term asset. We buy it. How do we handle the cost of acquisition? Should we allocate it over the useful life of that asset to expense? What if we do some repairs or improvements to the asset? And then finally, we may end up selling or disposing the asset. So we're going to look at really the life of an asset and how we will account for the major events in the life of a long-term asset. Let's begin by discussing the issues involved in recording the acquisition of a long-term asset. Here is the rule that governs this accounting as established by generally accepted accounting principles. GAAP requires all direct or incidental costs incurred in acquiring an asset and preparing it for its original intended use to be capitalized as part of the cost of the asset. In other words, we're going to include any costs directly incurred to acquire an asset or get it ready for its original intended use as part of the cost of that asset. Let's go ahead and look at an example here and see if we can't determine what kinds of costs should be capitalized upon the acquisition of an asset. In this particular example, we'll assume that a delivery truck is purchased by our business on the 1st of January in the year X4. It costs $60,000 and we pay for it by paying $20,000 in cash and executing a note payable for the balance. So we're paying $20,000 now and we'll be paying the remaining $40,000, at some future date. Now we don't have any of the terms associated with the note when in fact we're going to have to pay that additional $40,000 and whether in fact it bears interest that will be payable in the future. But at this point in time, we do have a future obligation to pay the principal of this note, $40,000 in the future. And at this point in time, we have incurred no interest cost because this is the first date of acquisition and time hasn't really passed. So the purchase price of this asset is $60,000 paid in cash and executing an obligation to pay cash in the future equal to $40,000. In addition, we pay an additional $1,800 in sales tax along with $1,200 in shipping and prep costs, and $2,000 for some customized paint job. I can see it now on the side of some truck. You got to publicize your business, so you may have to incur some costs to get that truck ready to go in terms of a proper paint job. Well, how would we account for these various costs that are associated with this purchase of this delivery truck? Well, certainly we should debit truck for $60,000, the actual purchase price, crediting cash and note payable to reflect the outflow of cash and the incurring of an obligation or liability to be paid in the future under a note payable. But what about these other costs? This $1,800 in sales tax that we had to pay upon the purchase. And again, we pay that to, the company that's selling us the delivery truck, but it ends up going to the state. So we really are incurring this cost, and the beneficiary ultimately is the state government. And what about the $1,200 in shipping and prep costs and the $2,000 for the customized paint job? Should those expenditures be expensed as a cost of doing business right now, or should those expenditures be capitalized as part of the cost of the asset? Well, given the requirements established under generally accepted accounting principles, and because any cost incurred in acquiring the asset or getting it ready for its original intended use should be capitalized, it's my impression that all of these, the full $5,000, probably should be capitalized as part of the cost of the truck. Debiting truck for $5,000 and crediting cash for these additional costs. Why is that? You can't buy the truck unless you pay sales tax upon purchase. It's just required. And, you can't use the truck unless you get it shipped to the proper location so that you can then utilize it the way you want, and it's properly prepped for its original use. And the fact of the matter is maybe we don't really have to have some customized paint job, but I want to have that for this to properly represent my business. And so I'm going to do the paint job to get it ready for its original intended use. So any of these costs here to acquire and get it ready to go before we actually start using it would be reflected as capitalized costs as part of the cost of the truck.